Friday, May 19th, 2023, Monaco 64, home of alternative economics and contrarian views. I've been warning about the UK economy for the last few years, not just because interest rates and inflation have gone up, but because we have a huge debt problem, the UK, and it's been brewing for a couple of decades. And we got a reprieve in the last six months or so, but I think things look quite rocky going forward. And why do I say that? Well, that's what we're going to look at today. The gilt market is pointing to more trouble ahead. And back in August of last year and even July, I was warning that we could have trouble in the coming autumn, September, October time, because interest rates are spiking very quickly. And yes, lo and behold, we had the gilt collapse, the sterling collapse, and the almost evaporation of the defined benefit pension system that the Bank of England had to step in and bail out. So before I start, just like to say I went out yesterday with a good friend of mine. We worked together in the city. He doesn't work there anymore either in the city. He's kind of retired now, Nick. And we went to this restaurant that we've been to before, like last year. And we got there just before midday, and there was a queue outside the restaurant. It was heaving, really. So the city of London seems to be doing okay right now, which is interesting. But maybe it's because Thursdays now are like Fridays because people work from home on the Friday. So it was a nice day. So they thought they'd go out for lunch. I don't know, but it was strange. So before we look into the UK economy, just to let you know, I have playlists. If you go into my YouTube channel, I have a UK economic collapse 2021, 2022, and it's continuing, unfortunately. And also the UK debt time bomb, which I've been covering for the last few years. And that's why interest rates are so important. And that's why also, in my opinion, and this is not me telling you what to do, and I did pick up a few ounces of gold actually yesterday when I was in the city. But yeah, I still think if you have savings in the local currency, it's going to get debased even more. And that's why I've been stacking since 2002. My friend Nick, too, is a stacker or a collector. And that's why I have an affiliation with Gold Investments. I've been dealing with gold investments for 20 years. And if you're looking to buy gold or silver, try them out. I mean, try every dealer, but I can vouch for Oliver and Simon Temple. I used to deal with their father back in the day, Mike Temple. He's retired now. And tell him that Monaco 64 sent you, or use my promo code online. You can go there personally. You can call them or use their website. Yeah, Monaco 64. You'll get a small discount off the offer price. So why are interest rates so important? Well, in every economy really nowadays, because especially in the West, we have economies that are based on financialization, on credit, a lot of credit. Consumers borrow to spend. It's the old Keynesian strategy that if you get consumers to spend, it will make companies produce more and will pick up the economy. But our economies in the West, and especially in the UK, have been hollowed out. There's very little manufacturing left. We are an economy based on finance, based on housing and consumer credit, and also a huge part of the economy, unfortunately, has been taken over by government spending. So the only way for governments and consumers to keep spending and living beyond their means, because all the good jobs have disappeared. Not all of them, but on average, you don't have high-paying manufacturing jobs like you used to. Well, consumers, governments, and companies have to make it up by borrowing. So when you have the Bank of England rate go from 0.1 back at the tail end of 2021 to 4.5% now, after staying at near zero for like, 12, 13 years almost, it's gonna like bring out all the bad credits out there. It's gonna shock the consumer. It's gonna shock, of course, workers that see their wages being eroded by currency debasement, because that's what we've had. We've had the QE since 0809. We had all the money, all the zero rates. Just to give you an idea, the average Bank of England rate since it was created in 1694 is more like around 5%. So for 12, 13 years, they kept that rate below 1. So is it any wonder that we have a problem? And yes, it culminated last September, October with the Gilt crisis, with sterling almost dropping to parity versus the dollar. And then we had, of course, Liz Truss and Kwarteng. That didn't last too long. People blamed it on the way they brought about that mini budget. And then they brought in a new government, a new chancellor. And all they've done is a bit of PR exercise. They haven't really... all they keep saying is, well, we're going to have inflation by the end of 2023. We're going to grow the economy. But here we are in June almost, and the CPI is still at 10%. RPI is still at around 14%. And the economy grew by 0.1 in the first quarter. But for the last few months, the markets had given the Bank of England and the government the benefit of the doubt, and bond yields had remained pretty much under control. And it's interesting because I was speaking to Nick yesterday at lunch, and he said, because he still likes to trade a bit, and he said he had to get out of his Gilt position, Gilt futures position, and because he told me it broke some key supports at the price of the government, the Gilt, 10-year Gilt. And I said, wow, I always look at the 10-year Gilt yield. It had been stuck around 385. It hadn't been doing much. And he said, no, it's broken some key support. So I looked at it this morning. And yes, this is a worrying chart for the government and for the Bank of England here. You can see that back in September, well, last summer, I was warning because yields bottomed around the beginning of August, and they're pretty much under control, but then they started rising very sharply there. You can see they went from below 1.8 to like 3.2, and then they just like exploded up to like 4.6 or thereabouts. And then, the Bank of England had to intervene. Liz Truss's premiership only lasted 44 days, and they had to try to fix things. And the Bank of England did not QE again. And as you can see, rates got back under control. And that's why it's interesting to know technical analysis, because you might say, how do you know rates are going to go higher? Well, because we've broken out here, as you can see, we've broken out the high from March earlier this year, around 3.9, and now we're back above right around 4%. So I think we need to keep an eye on this. It's going to hurt the consumer. It's going to hurt people who have to roll over a lot of the 2-year fixed deals, mortgage deals. It's going to hurt the government. It's going to increase the government's deficit. It's going to make the cost of living rise because the cost of financing rises. Companies have to raise their prices to cover that. That's one thing the Bank of England doesn't realize. And it's not just Andrew Bailey that's to blame. It's also Mervyn King, Mark Carney, who kept this zero rate policy and printed a lot of money. And it's coming home to roost for Andrew Bailey. And Andrew Bailey thinks that he doesn't understand really, I would say, what inflation really is. He just thinks that if he says that inflation's going down, that it will. Interest rates should be, above 10%, but they never will do that. And that's why I think things are only going to get worse. So we're going to keep a very close eye on these yields, and also the 2-year yield, as you can see here, which is quite important for mortgages. That's breaking out as well. It was kind of controlled here. There's like a resistance in the last few months around 388, but that one too looks like it's going to break 4%. Key level here is going to be also 405, and if we break through there, and we're going to keep a close eye, it's not pointing or boding well for the UK economy, for the currency, and batten down the hatches. And you might think, oh, you're always so negative. Well, I'm just trying to warn you about what's coming. Life doesn't stop, but at least hopefully it will help you in your decisions vis-a-vis your finances and many other things, I would say. So there you go. And we're going to keep a close eye as well on US yields, because these markets trade in tandem worldwide. But I think UK is pointing to trouble ahead in the next 6 months. And I think even the IMF the other day pointed out that inflation is going to rear its head again, that it's going to be troubling again, despite the fact that we're told that Powell has defeated inflation. So there you go. That's what I wanted to talk about today. And with that, let's quickly look at where these markets are this morning. Let me bring up my prices here. It's 8:15 a.m. London time. So we've got spot gold. Yes, gold has been hit hard in the last few days. We were above 2,000. We had been above 2,000 for quite a while. We're now back below 2,000, of course. We're up 8 this morning, though, at 1965. The high's been 69 and the low has been 51. Silver kind of bottomed yesterday. I did follow the markets a little bit, even though I was out. Early on, before I left, silver had broken through 23.50, which I thought was an important support. But then later on in the day, it got back above that level, even though gold was continuing to go down. So I'm not saying silver's bottom, but it looks fairly good right now, because it's up 1% at 23.75. The low has been 23.38 overnight. The stock market is virtually unchanged here. Except for the S&P is up about 3 points, just above 4,200. To the currencies, yes, and the dollar has been fairly strong against the major European currencies that make up the dollar index. But as I've said many times, dollar index is a distraction. All currencies are sinking versus real money. But be as it may, sterling is unchanged, 124.12. Euro's up slightly, 107.81. The dollar's down 0.5% versus the yen, 138.12. And to the other currencies here, we've got Aussie dollar up 0.5%, 66.50. The dollar's down 0.15% versus the Canadian dollar at 134.81, and the Kiwi dollar is up just over half a percent at 62.60. To the general commodities, WTI crude is up 1%, 72.58, and Brent crude is up another percent at 76.50. High-grade copper is up 1% at 373, and platinum is up $8 at 1,065. And now we'll go to the UK and US gilt markets. So we've got the 2-year gilt yield here up 3 basis points. It's just below 4%. It's at 398.5. But as I said, we've broken through that 380.85 level. The 10-year is trading just below 4%. But we're going to keep an eye on it. As far as US yields, we've got the 1-month T-bill at 5.52. The 2-year yield as well, that's risen a fair chunk in the last week. We were below 4%. Now we're at 4.22, even though it's down about 4 overnight. The 10-year yield is at 3.64. That's down about 1.5 basis points. So with that, I'm going to wish you all a very good day and a very good weekend. Take care. Bye.